Hello, 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 everyone. Hello. Hope you all survived today. Mike Arnold here, co-founder Path Trading Partners, along with Bob Iacchino, who will get on in a couple minutes. Anybody new here? By the way, please do consider subscribing, ringing that very important bell, and hitting the like or dislike button, although I don't know why anybody would ever dislike a video that Bob Iacchino is on. By the way, here's the earnings just to keep everybody posted with the sort of strong reversal capitulation day. We still have IBM after hours, Logitech. Those are the couple big ones I am looking at after hours. And then before the open tomorrow, we got Johnson & Johnson. Keep an eye. We'll take a look at GE. Definitely Verizon because of the communications sector. American Express for... related to consumer spending and debt and everything, and to see if they have more charge-offs or write-offs and everything else going that way, and sort of looking to see what they think about consumer spending and credit going forward. So those are the major. Let's see what else we're looking at. Just going to get Bob on in a minute. We had the flash manufacturing PMI today, slight miss, and we had flash services PMI, slight miss tomorrow. Consumer confidence, going to keep an eye on that. Not really much for Richmond Manufacturing Index, but I will glance at it. So those are the things I'm keeping an eye on tomorrow. By the way, here's the heat map as it looked at the close today. Here was the heat map the way it looked earlier today. So you can little change there. That was earlier today when from a screenshot you can see pretty much red across the board. And then here's the way it looks at the end of the day. Let me just refresh this just to double check. Yep. That was the latest one. So you can see the massive turnaround, at least a lot more green on the screen than earlier. So looks like, again, I had a number of signals today. Capitulation low, put a couple things in Discord, which is what I was watching. So we're going to take a look. Oops, I have ARC on the screen right now. ARC little, also capitulation bottom reversal. Got down that 75% retracement level. Now I'm watching for a bounce possibly back to the 83 area. But let's get into what Bob thinks. And here's, all right, we'll get Bob in a second. But here's your... this is actually a very bullish short-term signal today with this long, and I'll show you what, if we have time, the entry signals I saw, but watching for a potential bounce over the next couple days back to the 4,500 area. Let's see, that's a weekly chart. 4,509 is a key resistance area now with the declining rotation zone. All right, we got that in. Should I put Bob on the right or the left? Hold on here. Let's see. Let's see here.
Float.
Let me get you. Hold on. I got to unlock. Well, I got to make some changes. This is, you know, oh, you got two of me now.
That is weird looking.
That is very scary looking. Now let's see if we can get Bob. There we go. Look how my head now. See, I have a problem. I have a problem. With the green screen, I didn't recalibrate. Look how big my head looks in comparison to Bob. How can
And we
I
all know
remove
my head's
myself?
way bigger than yours.
Yeah, how can I remove myself, though? Oh, well. You'll have to deal with Big Mike head today. Wait, oh, wait, that removed both. I'm just going to put Bob on for a while. There we go. Bob solo.
I'm solo. What's up, guys? It is definitely a new world when IBM is beating on earnings. Everything's completely different.
Well, what did you see? I haven't seen yet, but what was their tax rate? I mean, they're notorious for having like some absurd tax rate and everything else. And we beat, but we literally got money from the government.
Let's see their tax rate negative. Wow. Negative 54.39 was their pre-tax income growth. Annual effective tax rate. They didn't put it out yet.
Okay, because they have some insane. It's one thing that they're notorious from, and then we already took. Oh, look, they're popped after again, if you didn't get in on that capitulation low, it's all over. Look, see, this is the thing. Again, obviously they beat, but all right, you had a capitulation bottom in a lot of stuff today, but now it's up to how much is that? Eight. What percentage is that up? I can't even do math right now, but you're up $8 on a $128 stock after hours.
Yeah, it's about 5%.
So, all right. So there's that. I mean, I think we definitely have a capitulation bottom. I'm just scrolling through the markets, and you're up by yourself on the screen. People can just hear me talk, but you can see if I hide. There's the Nasdaq reversal. What were the lows today? Down to 13,706, trading 14,484. S&P, you can see that major reversal, and the Dow major reversal, actually getting back above a very key level of this 34,000. So what are your thoughts on this price action today?
Well, we had the S&P drop to a full correction, down 10% intraday. We had the Russell pull into bear market territory intraday, but neither one closed there. And actually, Oliver Rennick from TD Ameritrade, one of the TV anchors from TD Ameritrade, actually hit me up on Twitter asking if that mattered. And as Mike has told all you guys over and over again, only the close matters. And we closed positive. So looking at that particular spike off the lows, that seems to me to be, well, I'm going to say something that I make fun of when other people say it. That seems to me to be pretty algo-driven. It was really fast. It was a really big move back up, really fast. It seemed to me to be pretty algo-driven on the upside of things. Now, I have a history of saying that when somebody says something is algo-driven or technical in nature, it's because they don't know why it happened. I'm in that camp today.
So you're going with the default algo-driven. There, my big head's back.
It's a technical move. It's algo-driven.
Is it? Are we back to risk off?
We're back to risk on.
Oh, we're back to risk on. Sorry, I get the two mixed up
on,
because they're so insane.
Right. No, look, I actually did get a message from somebody, codename Mongo, who said that some of the algos he worked with were buying at those lows and continued to buy all the way up in toward the close. But it was about covering shorts prior to the Fed. And they thought that was a really good level to cover shorts, not necessarily a good level to get long. So it seemed like a lot of it from an algorithmic perspective was short covering.
And there was, I mean, we had some momentum bars. Here's my intraday stuff. If you'll humor me for a second. First little shot was this with these momentum bars right here, and then we closed. It's what I've taught people. You put the little area it's on. You want to return to this 50 to 62.5, and you watch for a little pop up with your stop on a closing basis below 62.5, so you can keep really tight stops on these rotations. That one, quick little stop out, but then this one caught really nice with a little double bottom here trade. Pausing bar that didn't even try to pull back. And when you have a pausing bar that doesn't pull back to 50 to 62.5, you just play the breakout trade. And that was a breakout trade, returning to the breakout zone, and then it just ripped. Mm-hmm. It just ripped higher. So there's a capitulation double bottom down here with divergences and then momentum bars off those lows. So it was just take a couple stabs with today without how there was just blood in the streets at some level, and people were throwing in the towel, and that's when I really start looking for the all right, we might be putting in something, at least a short-term bounce for a 3 to 5% bounce here.
Yeah, I think it's definitely a short-term bottom. I don't know if it's the medium-term bottom. I'll tell you after it happens, but I think it's a short-term bottom from a perspective of we do have the one thing happening on Wednesday that could easily spin things around. Any sort of now weakness out of the Fed on Wednesday, any sort of weakness at all, which I can totally understand people expecting or looking for after the 2-week move that we've had. The Dow down 7 sessions in a row, counting this morning. The 3-week or the 20% move in the Russell, the 10% move in the S&P. All of this seems, and we were just short of 15% in the Nasdaq on the lows. It might have been 16%. And so those kinds of moves with the Fed coming up, if there's anybody out there that believes that the Fed is driven by the equity markets, then they're likely to be a lot less hawkish than I think the market is pricing in, the market's expecting. When you look at what happened with yields, yields were falling all day, all day. You look at the 10-year note, the 10-year note this morning, 171. When I last looked at it, it was 175. On Friday, we had 180s. Last week, in the middle of the week, we had 183 on the 10-year note. So yields were falling all day long, basically from the open on. We had an initial spike in yields, and then they started to fall. And they fell precipitously after the PMI numbers, the market PMI numbers that came out in the U.S. today. All three numbers, manufacturing, composite, and services, all weaker than expected. Manufacturing was the only one that was slightly weaker. The other two, the services and composite numbers, were much, much weaker than expected. The U.S. is a service economy, and the market services PMI came in at the 50 level, so almost into contraction territory. Now, you can say it has to do with Omicron, with people not performing their service jobs, but that was an ugly piece of data for the Fed to be tightening into. A really ugly piece of data for the Fed to be saying, yeah, so we're going to start quantitative easing and start tightening. That's a weak economy to be doing that into.
So how do you, here's the yields, by the way. I mean, we came back down to this 171 major support level with the daily rotation zone, and you can completely trade yields with the technical tools just like you can bonds. I mean,
yep.
Even just looking at the yields, you can trade them technically, but then look at that reversal off the prior major resistance becoming support with the bottom of the rotation zone, and nice little reversal back up. So it's drawn it tested that level last week. We got the bounce, and then we've retested that level. So that's a clear line in the sand. If we break below this on a closing basis, then I'll think that at least a short-term top and the yields are in. But until that happens, we still have the upward trajectory on them.
So you can look at if any of you are ever wondering what the market is pricing in from an interest rate perspective, in terms of the Fed, just type into Google CME Fed Watch Tool. Okay, and it's a really easy tool to use, and it'll tell you what the CME products are pricing in. That's the Fed funds futures and now the silver futures as well, which is a new version of LIBOR. That's getting too deep in the weeds for people on interest rates. But the CME Fed Watch Tool on a daily basis prices out the possibility of changes in interest rates. And we haven't needed to look at it for quite some time. In the January 26th meeting, come on, switch over for me, buddy. There we go. January 26th meeting. Currently, the Fed funds target rate is 0 to 25 basis points, so 0 to 0.25%. And the CME products are pricing in a 94.4% chance of no movement in rates. And I think that's pretty much what the market expects. But when you go to the March 16th meeting, the market is pricing in an 81.3% chance of a 25 basis point rate hike and a 4.8% chance of a 50 basis point rate hike. So what's interesting about that? Well, on Friday, that was 91% chance of 25 basis points, and it was an over 5% chance of 50. So what does that tell you? Market participants are pulling back on the aggressiveness in the Fed. Ever so slightly, but they're still pulling back on it. They're saying the Fed is already positioned to be less aggressive than they were Friday. And I'll bet you after tomorrow, it's probably even worse, especially if equities rally. Equities rallying would be kind of leading into this idea that the Fed is going to at least be less aggressive. And I don't think they are. I honestly don't think they are. If you saw President Biden's speech, that hour and 52-minute rambling that happened last week, he basically said inflation is the Fed's job. That to me is political cover for the Fed to allow markets to drop while they back out of quantitative easing and potentially even raise rates. Because if they don't start getting ahead of inflation now, The Fed can either have 7% inflation and a strong stock market. Remember, inflation doesn't actually hurt the stock market. They're actually pretty positively correlated. When you have inflation rising, you tend to have the stock market rising as well. It's called asset inflation. So the Fed can either have 7% inflation and a positive equity market, a strong equity market, or they can have 1% to 2% inflation and weaker equities. They really can't have both. They can't ride two horses at the same time. And if they just try to kind of tiptoe around it, they're liable to have a recession and 7% inflation if they tiptoe around it. So they have to actually be aggressive or back off and not worry about inflation. I suspect they're going to be aggressive. I really do. Could be wrong, but that's what I suspect.
Well, it's interesting because I was seeing, even especially when we were down today, people that I chat with and follow and stuff. They're like, oh, we already need to go to putting in QE. We haven't even, we're
We didn't
only
take it
cut
out.
it in half.
We didn't even take it out yet. How do you re-put it in?
Well, they put it back in they got to go back to the full amount. And then if we go into recession, like if it keeps slowing down, we got to cut rates more into negative rates. And I'm like, you can't, if the market's that fragile, where we can't
Last week we briefly had positive rates in Germany, positive nominal rates. You guys know the difference between nominal rates and real rates? Nominal rates is just what the rate is. So for example, if the 10-year is at 171, the nominal rate is 171. And real rates are the nominal rate minus inflation. So Germany has existed with negative nominal rates for, I don't even know how long, quite some time. Last week, we actually had a positive for a brief intraday moment. We had positive nominal rates in Germany, which is crazy because you just haven't seen it for a long time. By the way, we also had the ECB last week, European Central Bank, telling people that we are in a different situation than the US. We don't have supply chain issues and we don't have labor shortages, and therefore we don't have to be as aggressive as the Fed. So there was already one of the central banks saying, no, we're not going to be aggressive. They are, but we are not. I actually take that to heart because that, to me, they do talk, whether they say they do or don't. They do talk. And while she was answering a question about, are you going to be as aggressive as the Fed? She certainly didn't opine and say, I don't consider what the Fed is going to be doing as aggressive, nor would I have expected her to, but she didn't react to that at all. Her exact answer was, we don't need to be as aggressive as the US Fed because we don't have the same economic situation. So I thought there was a little bit of telling language in there. And again, President Biden gave the Fed the political cover to say, yeah, we need to fight inflation just like Biden said we do. So I could be wrong.
Well, it will be interesting to see what happens, at least because the market. I mean, I've see the other end of the spectrum that says, well, this is the low. We're going to new highs because the market is already priced in 7 rate hikes this year. 7, or sorry, 6 to 7.
I don't know where they're seeing 7, but I mean, I guess
7 rate hikes.
Who's priced that in?
The market has.
In what contract? Like, you talking about equities, or where's that priced in?
No, it's just some chatter from some
chatter from people,
firms. Yeah, some Wall Street firms. They're already saying it's already fully priced in, even multiple rate hikes. So whatever the Fed does, this was the bottom.
I mean, you can go out to, okay, so this kind of supports that. If you go out to the September 21st meeting in the CME Group's Fed Watch tool, remember, right now we're 0 to 25. Okay, that's where rates are right now, from zero rates to 0.25%. They have rates being at 100 to 125, which would be what, 5 rate hikes?
Yeah,
4 rate hikes.
25
basis
100 to 125.
Yeah, at 24%. The probability of that at 24%. That's by September. If I go out to February 1st of 2023, 150 to 175, which would be 5 to 6, is priced in at 10.7% probability.
So I don't see that.
That's what the actual rate market is pricing it.
Right.
I don't know what the other people are saying.
So we're kind of quick. Well, Rich says this bounce is weaker than my left arm. Well, there is actually an opening there. You left yourself open for, Rich, but we're not going there. Uh, let's see. Shashi asks, well, can you talk about volumes? Why there is 2.5 times volumes in all shares?
Well, one of those reasons, and Mike, you can speak to it as well, if not better than me. One of those reasons is options, and another reason is short covering. Hedging, delta hedging options and short covering causes ramp ups in volumes. But also, Mike mentioned the capitulation. If you know what a capitulation is, it's people who have been holding on for you. Looking at this chart that he has on the screen right now, you've got 6 consecutive down sessions there. You might call it a doji on the one there, but you got 6 consecutive lower closes for the most part, or at least 5 of 6. People finally saying, I can't take the pain anymore, and dumping shares that they've been holding on to will cause higher volumes. Mike, I don't know if you want to add anything to that.
Yeah, and I mean, there's just I mean, we had a little more short interest going in today, but we're still at very low short interest. But once you broke some of these major lows, especially the 4,300 level, it was, and then you got margin calls on top of it from people just, okay, I'm going to hang on. It's the lows are in. The lows are in. It's why also we talk about, I did on the live stream yesterday. You don't just, I mean, I was looking for the lows. We're getting close to being the lows in, but, this is why I also said you just don't buy. You just don't, like yesterday. Well, because I got a question after the live stream. Well, why again? And I said this on the live stream, but why don't you just buy if you think that we're close to the lows? Because you can have days like this that just flushes everything out. Because a lot of people thought we were close to the lows, and on a closing basis, we were. Not on an intraday basis, but what's the most important? Again, we've talked about this for years. The most important level is the close. But the thing is, the intraday price action flushed everybody out.
Right.
So you can see that in the S&P broke that key 4,300, and you look at here's the Nasdaq. Let me take off the indicators. You just look at the price action charts. You start to break below about 14,400, and you're into. I mean, it was just, oh my gosh, this thing's we're in full blown crash mode, and then it was okay. We got that. I mean, there were a lot of algos going off, and even on the Discord server, the tick started. We had horrible tick early on. I mean, it was, if anybody watches the tick indicator, the NISE cumulative tick, here's the opening bar. I mean, we opened at close to, what was the lows here? Negative 1,800. That is absolutely a brutal selling print. Okay, there was just selling across the board, and then we started to firm up later in the day. So there was some major just selling at the open, and on any rally attempt, it was just sell, sell, sell until it started to firm up, and we couldn't get key closes back below about 1,300 on the tick, which led to some short-term bullish price action and some algos kicking in, where you had a lot of sweep orders coming in that were just buying baskets of stocks today. It was just like buy across the board. Buy your Apples. There are some large orders going off, sweeping up like your Apples, your Microsofts just simultaneously. So we started to see that, which is algo-driven. It's not a fund manager saying, okay, I think we're going to buy a little here, a little here. It's just like buy. And you hit the button and it's buy. And it wasn't even hitting a button. It was just stuff got to such an extreme, then started firming up. And that's why we watch for those momentum bars off the low that we've talked about.
How the meme stocks do today?
What, the old memes? Well, again, look at the momentum in AMC off the low. which I don't know why you're rushing into buy AMC.
There's no rush to buy AMC.
I mean, but look at. I started off. I had this on the screen before. Here's ARK. I mean, look at the reversal in ARK, which is still dominated by complete trash.
Yeah.
But this shows you. I mean, people were rushing to even buy, or stuff was rushing to even buy complete trash because we were in such oversold conditions. Let's see. Let's see. Let's short term. I think some short term lows are in for the next couple days at least. We're gonna have to see how strong this bounce is, though. I mean, I hear people saying we're going to all time highs now, and I'm not seeing that. I'm
I don't
not.
think that's happening.
Especially, I did a sector analysis yesterday. There's too much weakness. Now, we got to major points of some little stupidity on a short term basis, but which the market tends to do, just as it can get to, it can remain overbought for a lot longer than you think. It can remain oversold until you get these capitulation bottoms. However, we're going to have to judge the next thing, and the stuff I'm watching for is about a 3 to 5% bounce. Uh,
There's something else I want to add to that, if I could, Mike.
sure.
Um, where you say, is this a relief rally or a longer term bottom starting to form? Longer term bottoms start with relief rallies. So it's one of those things, Wavy, where I want you to, if you can, for some people it's difficult to do because it's just the way your mind works, but um, try and take a step back in naming things and just react to what's happening in front of you. Because I have a client who is not smart enough to watch Mike's live streams every day, and he'll just text me out of nowhere, is this a place to nibble? And I get so frustrated with him, I'll say, I don't know. I have no idea if it's a place to nibble because I don't know what you mean by nibble, right? And so when you try to name things like that, uh, a short-term bottom can start with a relief rally, right? And then you get a little bit of sideways movement, and then a bottom forms off of that. And also, I would say that a short-term bottom is something that we would call price action almost after the fact, not necessarily as it's happening with one long bar like that. Now, looking at it, I would say it's a relief rally, but that could mean 3, 4, 5 days and then another sell off, or it could mean a long term bottom being formed. It's just too, if you get your mind around the idea of naming these things like that, you're going to confuse yourself. You're going to say, oh, good, this is a relief rally. And then later on, when a bottom forms, you don't know how to react to it. Try and be a little bit more reactionary. Does that make sense?
Yep. Let's see. Let's see. Andre asked, do you and Bob feel the Nasdaq and Tesla to continue to rally for remainder of 2022, or do you feel Nasdaq and Tesla will go down due to Fed tightening, money policy, and possible current bubble?
Well, one could go down, the other can go up. I mean, that's
So
possible.
speak to the Nasdaq.
I think the NASDAQ will be positive by year end, but I don't think this is the only sell off we're going to get in the NASDAQ. And by positive by year end, I think it could be up 1% to 3%. But that could change depending on how this sell off goes. I've been saying for a long time, this reminds me a lot of the 1999, 2000, 2001 time period. But because these sort of 12-month periods of time are arbitrary, I tend to default to what I consider to be a fact that it's always going to be tech for us going forward. We're not going to go back to the cotton gin. We're not going to go back to the loom. Tech is going to be driving the economy for the foreseeable future. So if somebody says to me in January, where do you think the NASDAQ is going to be at the end of the year? 99.5% of the time, I'm going to say positive. But I think there's a lot of pain we have to go through this year. And if we don't go through that, that means the NASDAQ was positive, and we'll probably go through it next year. There's a realistic repricing, and I believe a lot of tech companies need to go bankrupt before I'm willing to say we've got double digits for the next 5 or 6 years in a row. Does that make sense?
Well, also, you have the unprofitable tech index. I mean, those stocks are just getting, besides today's bounce, for the past few months, they've been starting to get destroyed. The unprofitable tech index. So, and I'm not talking the Microsofts and the Apples. I'm talking the companies that, after revenue, they're still burning hand over fist through money, and they just need complete. They need constant reinvest to raise new money just to stay afloat. And
Yeah.
that's in some ways similar to the end of the dot com thing too, because we saw that same thing that just firms start dying. You know, you got the sell off, and then we actually, after that first sell off in the bubble, you had a very decent bounce when everybody thought we were going to new highs again. if you remember. I mean,
Right.
that was the Nasdaq from back in the day. Here we go. I mean, I remember this because we had this major, and then we had capitulation moves, a couple of them, but everybody's like, all right, this is a capitulation move. We're going. It's now. Then it turned into, oh, it was just a relief rally. Then this one was the full blown. We're going to all time highs. We're going new. We're going. And then, it ran up. This made a higher low, and people were saying, see, we're done. And then we bled out. Because you
What's
had,
that? What's that saying, Mike? That bear markets happen slowly, then all at once. Or I know
yep,
I've got that wrong right now, but that's what this chart that Mike's showing right now is a great example. People look back on this particular period of time and go, "Wow, the sell-off just happened all at once." It did not. It took a year and a half for it to fully start into bear market mode. And you kind of look at the way the market progressed through that. There were people who were long the tech stocks and the garbage that was around in 1999, and they did not believe it. They thought, okay, finally it's over, we can buy again. And then finally it's over, we can buy again. And it took a while to shake them out and get them to understand that when a market is repricing, that's a bear market. Markets repricing are bear markets, and we haven't had that yet.
I mean, that first sell off, and this is, on a weekly basis, was the beginning of April of 2000. And then it didn't really break on a closing basis. I mean, we had this little break below those lows, which was May, but then it didn't fully break down until November. So what's that? April to November? What's like 7 months of major? Oh, the bottom's in, the bottom's in, the bottom's in, the bottom's in. No, it's not. So these things don't turn on a dime, but again, everybody's all right. It's a relief rally. The bottom's in. It's a relief rally, and then eventually it wasn't. So could we be doing the same thing now? Yeah, we could be.
Right.
It's one of the things I follow that there's been some major a system now. The only time last trigger was that a system I follow was 2008, which had a sell signal. Now it's a sell signal. What's interesting enough is it's a sell signal after this relief rally. So I'm going to be watching for a rollover. But the last time was 2008. The time before was in that 2000 time period. The only thing difference now is we have the Fed fully entwined in the markets, where the last two times it wasn't. But that's that's what's the only difference with this sell signal before the last two. But interesting enough, it's the sell on the next rally. It's not the sell from today's lows or from today's close. It's the sell on the next rally bounce up.
Hey, Mike, I want to jump in time for you to do some technicals because I think it's really important today. And there's two questions there I want to answer. I emailed you a link. Michael Jones's question on the rate of the taper. I don't know if you want to put that question up and I'll read it. Maybe you can share the link. I don't know if you can share the screen that quickly or not.
Yep. Let's take a look at a couple of these real quick. There seems to be a consensus we are in a huge bubble in terms of Apple and Tesla, but Bob disagrees. What are your thoughts?
No, I don't disagree with that at all. I think we are in a huge bubble. When somebody's asking me to predict 11 months from now, because that's what you said, how's it going to end up on the year? At least that's the way I took the question. I think the Nasdaq will be positive on the year. But I'm going to say that every year probably for the next 10, just because tech is tech. Tech's our future. So, but you can ask me again in a few months. It's hard to say what indexes are going to do. And I don't believe the Fed will stick to it. I believe the Fed will do, and this is answering the question there. I believe the Fed, or whose question is that? Michael Jones. I believe the Fed will begin to taper, and I will believe that they will act aggressively. And then I believe they will flip on a dime sometime in the end of the second quarter, the third quarter, which will bring about the rally that I think people are hoping happens. The people that are just relying on the Nasdaq and tech to continue to go higher. And that will look very much like the chart Mike just showed of the 1999-2000 period, where we had a low, a rally, a low, and then we rallied, and we actually rode along those highs for months, right? We didn't have that second capitulation that turned into a bear market. This is the Fed's balance sheet minus things that have rolled off because they've expired, right? So it's total asset less elimination from consolidation. For elimination from consolidation means that the duration ended and they consolidated the profits into the balance sheet. And you can see that thing is still straight up. They have not begun to taper yet. This, I believe, goes through the 18th.
Wait, there's a little dip there. Look at that. Look at that.
Oh, there's a little tiny dip there. That little dip is them not buying and things expiring. So they have not begun to taper yet. They've stopped their QE right there. But if you look at the way the balance sheet worked out, no, they have not begun to taper yet. And that's what we're going to be looking for in this Fed meeting is when the actual taper begins. The Fed may say we began the taper last week, in which case it wouldn't be on this graph yet. But no, they've not begun to taper in any real way yet. So you can look this up yourself. You just put in, I forgot what I Googled to get it, but Fred is the Federal Reserve of St. Louis. You can just look up the Fed's balance sheet. Just Google Federal Reserve balance sheet, Fred in all caps, and this link will come up. And you can click on it and you can watch this chart. You can see what the Fed is actually doing versus what they say they're doing or what people are telling you that they're doing. Like people may say, well, the Fed's tapering now. You can look at this and go, well, as of the 18th, they were not tapering yet. So that's the answer to that question.
And I'll put that link in Discord for everyone too. Who's a member of our Discord server. Mm-hmm.
There's one more in there I wanted to answer before
Wavy, I let you. Mostly tech are highly inflated, trading at P ratios far beyond reach. The correction is good for long-term investors.
Agreed.
Was HFT an algorithm trading in the 1999-2000 timeframe? Yeah, but not to the extent it is now.
Not to the extent it is now. And then somebody asked about comparisons to 1999. I think so my comparisons are somewhat anecdotal, and then Mike had that chart up, right? So we probably can't overlay them right now, but you'll see how similar they look if you overlay a NASDAQ chart from now in 1999, 2000, and you can kind of curve fit it and make it fit, but it looks very familiar. Also, the things are anecdotal, the easy money, the GameStop, the AMC, the crypto, all of those things. We have those things in 1999, 2000. Mike and I have talked about them a lot, where I actually had guys in the pit. I was working on the trading floor at the time, and guys that couldn't spell NASDAQ would be coming to my phone and say, hey, let me use your phone real quick. I want to get out of Red Hat, and then I want to put an order to get back in it, and then I want to put an order to get back out of it after that. And they were doing those pet.com and flowers.com and Red Hat, and some of these stocks still exist, like Red Hat. Some of them don't exist any longer. And they were trading in and out of these things and making tens of thousands of dollars a day. And I'm sitting there going, I know this is not the right way to trade tech. I know it's not. So I wasn't taking part in it. But they were making real money, just like crypto people are. So it's these bubbles that I recognize anecdotally, and the actions of people, like you say, when your taxi driver's asking you about stocks. Every single person I bump into asks me about the market and asks me about crypto. I mean, old ladies on the street are asking me if they should be in crypto. And I live in Naples, Florida now, so I bump into a lot of them. And they ask me if they should be putting money in crypto. Or market went down today. Is it going to go back up? And I'm like, shouldn't you be working on chocolate chip cookie recipes? You shouldn't be in stocks. You're 80. And these are the things I remember from 1999, 2000. They're anecdotal. And then the charts look eerily similar.
Well, the challenges in the stocks are pretty much the only game in town if you want any return. I mean, you can't put your money in the bank and get any return.
Right.
And look at the yield on bonds. Even bonds you're going to tie up your money for 10 years at 1.7%. Where are you getting? That's essentially with these rates where they've been for besides the last little when they tried to hike them a little last time, rates have been so low for so long. Where do you get yield?
Right.
So it's forced everybody into the market. I know people who are in their 70s and 80s who are literally active day traders at this point. That you shouldn't be day trading with your money when you're 80.
Right. Right. And I'll answer the question, if so, who will buy? There's quite a balance of MBS and bonds. There will be buyers at higher yields of those products. And understand that when they taper, the traditional buyers of MBS and bonds will wait for higher yields, and then they will buy it. And they will buy it with the assumption that the Fed is going to come back in and hack at rates again. It's the same assumption that I have. So when you get better rate levels on MBS and on bonds, the traditional buyers represented by banks and hedge funds and insurance companies will buy those things up. But it's going to be at higher rates, and there's going to be pain before that happens. So that's the issue. It's not like the Fed has been the only buyer of those things. They've been the only buyers at those ridiculous rates. When rates adjust back higher to where they actually have value, the institutions that were buying them in the past will think, okay, pretty soon the Fed is going to come in and prop these things up. So they have value right here. And they'll buy them at levels that they probably wouldn't have bought them prior to the Fed's involvement. So, and no, I don't think that's priced in quite yet. I have to see a 225 10-year before I think that's priced in.
So I guess that's related to Michael's question.
Yeah.
I will have to work on overlap those charts. I'll have to try to figure out a way we make a transparent background and overlap those charts so we get it. Rich says, Mike, you were wrong about USD CAD. I don't even know.
Remember, Mike's never wrong. And I don't mean that facetiously at all. Mike is saying what the probabilities look like. I don't think Mike is ever saying you need to buy this today.
The only thing I see now is we triggered the double bottom in that. But before, let's see, I had charts. I remember covering that. I've not been involved in the U.S. Come on. Where's? Oh.
Thanks, Wavy. That's nice of you.
Let's see. Thanks for the enlightenment. You guys seem to prepare for every year brings. And am I right about everything? No. You have patterns that fail all the time. But you got to analyze and stick to your stuff. At this point, I wonder, did that go to full target?
Looks like it did.
Yep. Full target.
I'll tell you, and I'm not actually like being defensive, Noble. Was it Noble that said that? No, it was Rich Beast. There is no right and wrong in high probability trading. We had a member of a service that Mike and I had years ago. His username was Mad Pommy. And he sent us a statement once. Remember him?
Yeah.
Mike, do you remember Mongo?
Yep.
I ran into him in Florida. We're going to dinner this week. He's here for 2 months. He actually came up to me. I had never met him in person before. Anyway, if you have a pattern that, well, let me go back to what Mad Pommy said, and then I got to let you guys go. He sent us a statement once that I still love. He said, losing trades are the opposite. How did he word that? I got to find it. It was something to the effect of losing trades are the opposite to winning trades. One cannot exist without the other. So in other words, if you have a pattern that has a 67% probability or a 62% probability, and you control risk reward, a losing trade that you've done correctly you're not wrong to take it. Because in order to make the probability work in your favor, you have to take all of them. And you have to control your risk throughout all of them. Because even if you have something that's 90% probable, that means out of 100 trades, you can lose 10 times in a row. And that can be painful, 10 times in a row. But you can't say, I'm not going to take this one because I don't like. We had a guy that didn't take a Hormel trade that we sent out once. He was a friend of mine. We sent out a long trade in Hormel. And I said to him, did you take the Hormel trade? And he goes, nah, I'm not a chili guy. But he took the Heinz trade. He's
a ketchup guy, not a chili guy.
He's a ketchup guy. And the Heinz trade went to its stop out, and the Hormel trade made more than the Heinz trade lost. Right? So again, Rich, you're a regular here. I don't think you were like being argumentative or nasty, but I wanted to clarify that I wasn't being defensive. we take every good setup that there is, and we know that a certain amount of them are going to lose and a larger amount of them are likely to win, and we control our risk. And that's how we exist for 30 years. So we don't look at trades as right and wrong. We look at trades as winners and losers. That's it. The losers are correct. It's the complementary probability to the winning trades. One cannot exist without the other. That's how he worded it. Complementary probability.
Yep, you saved that quote for that very specific reason.
Yeah.
Michael Jones, thanks. Both of you, this has been incredibly insightful. Bob's going to be back on Wednesday after the Fed
I'll be back on Wednesday.
Genomic Stock, thank you for the $20 super chat for both of you. Great job. Thank you. And, Bob will have another follow-up based off of what the Fed does. Okay? Jake the Snake, that's exactly right. Thank you, Bob. This cannot be stated enough, especially with today's thought processes. Rich, gotcha. It's pure technical analysis from Mike. He shows us both long and short sides. One of the few on YouTube who won't come in with a biased, one of a kind TA here. I mean, and his technical analysis, look, I got to go with the probabilities. And I've put out stuff that you got to take stops. We have to take stops all the time. It's why you have stops. It's why I also say in these kind of conditions I put in, if you're trading around a core position, which is great in this, you take something off, you get your stop to break even. If it keeps running, great. If it comes back and stops you out, great. Yep. There's certain times in markets you can play volatility more and you can have a little wider stops. There's times you have narrower stops, but you don't just sit and not have stops. And you don't just sit and pretend you don't have losing trades, because you're going to have losing trades. Even if you're an investor, you're going to have losing trades. There's just some companies that don't come back, even if you're saying I'm never taking it off. Well, if you ever owned a WorldCom or an Enron there are people who said WorldCom's never going to zero. And oops, there are people I know who were trading pairs trading GM versus Ford and said GM will never go bankrupt. And
Bear Stearns, Lehman.
I
was involved with a guy who he tried to recruit me to sell principal guaranteed bonds. And I said, what do you mean principal guaranteed? How can you guarantee the principal of a bond unless it's a U.S. Treasury? And even that, they're basically guaranteed. But he said, well, they're guaranteed by Lehman Brothers. I said, okay, well, that's not guaranteed. He goes, well, not what? Lehman Brothers are going to go out of business? Exact words.
I
got to go, guys. Mike,
all right.
I'll talk to you guys tomorrow, and I'll see all you guys on Wednesday.
Yep. All right. Let's see. Hope you guys enjoyed that. We will have Bob back on. You just don't have to deal with me on the regular basis. There's Small Me again, by the way. Small Me is back. It's a coin flip analogy too. I've just what wipes people out. Because I was, I played a lot. I used to live in Vegas, and I did a ton of card counting. Did a ton of. We had a system that would identify way back when messed up probabilities on roulette wheels, because if they're slightly out of balance, you can have certain sectors hit more often than not, and there's some casinos that didn't balance their wheels properly enough. But what I'd see is you get people like after 4 blacks, and they're like, all right, it's got to be red. They bet on red. Then it hits black again. Then they double their bet on red. Then they double their bet on red. And you could have 12, 13 blacks in a row. It wipes people out. And they're like, no, but it had to be red next time. No, it didn't. It might be very small probabilities that black continues, but every time you spin the wheel, unless you do have the unbalanced wheel, you have, and ignore greens, 0 and double 0, you have essentially the same probability on red and black. It's the coin flip. You can have 20 heads in a row. Is it likely? No. But it doesn't change the probability unless it's a misweighted coin or a gimmick coin. Your probability is still 50-50 next flip. Your probabilities in the long run, and you can have clusters, like double bottoms can have clusters of losing trades when market's shifting. Double tops can have clusters of losing trades. But you have to base things on long-term probabilities, and that's why I have to go with. I can't keep Just because I might have 4 or 5 losing trades in a row, it doesn't matter. Just like, all right, we had capitulation in the S&P today, but the first thing I put up, and you can go back to Discord, I put up watching this, and I put up trade stopped out. But then we caught this one. Double bottom, and then capitulation, pause bar, and then it was off to the races. Why? Because the other stuff I put up with the tick firming, with the trend and everything else, we caught something. Does that mean just because one trade was wrong on a quick stop that, okay, throw in the towel? No. There's sometimes you got to trade the probabilities. That's what trading is about. And if you don't have probabilities, that's where you got to start looking at it. All right. Let's see. I'll go for a couple more. Oh, we had a question on Shop. Hold on. Let me just see. Again, I'm watching. One of the things I follow actually has a 70% odds that tops are in, especially in the Nasdaq this year. But does that see? You got to still play the probabilities. Now, if we come up and rally, keep rallying and get near the highs, could it be wrong? Yeah, it's got a 30% chance that we could go to highs, but I got to play the probabilities until something changes. That's what it is. That's what trading is. Shop, again, there's no double that triggered. So again, also I want to point something out to people who watch this, especially on the recordings, because again, there's a potential trade does not mean it's actually a trigger trade. There's a potential double bottom with Shop. I get this all the time. You were wrong on your double bottom. It never triggered. The probabilities of what do we say for a trigger? It needs a close. So Shop at this point, I mean, again, we've had this short-term break. I'd be watching for a Shop return to about 10.50, 10.53 easily. And again, I'd use also across the board on everything you're watching. I'd be watching if we get above the first daily rotation zone. I'm watching here as the first little level to see how it reacts. Then I'd watch the 37.5 with the daily rotation zone. You get through there, then I just target the 50% retracement of the whole down move. What's interesting enough is you could easily still, this is what will suck people in. Let's say Shop goes from 938 to 1281 over the next couple weeks. Let's say we have a longer term bottom put in. This is what will suck people in. But where's my line in the sand? I'd need a close above essentially 1400 before I got into full bullish mode. Are there bullish plays? Yeah. There's a bullish play right on the 4 hour. There's a bunch of stuff triggered. There was a great bullish trade. I wanted to show you something else. I watched this percent B, which I'm going to put out soon. There was a percent B trigger right here on an entry. 43, what was the close? It was actually on this close right here. Now, a lot of people, 43.18. You had to have a stop below here, so you had to position size accordingly to manage your risk. But this was a nice little, and this bar didn't come close to stopping out. But people are saying, well, I could have bought down here. Why did I have to buy up here? Because the probability shifted once it was up here. You didn't know it was going to get up here till it traded up here. That's why we have to wait for doubles to trigger. Okay? Because there's no probabilities with those targets until they trigger. You know, there wasn't probabilities on Apple, which came down, you know, by the way, Apple now, I'm watching for a bounce, and it did hit the first and second targets, so I could actually see Apple easily getting back to 167 here. But until Apple closed below this level, the probabilities weren't there. In hindsight, it looks easy. Well, why didn't you just sell up here? Because it could, you knew it was a potential up here, but it didn't trigger till here. You didn't have the probabilities favoring the price action down like this until it triggered. Conversely, if I shorted up here, and let's say we didn't, let's wipe out all of this, and then it went to new highs, then everybody said, why'd you short? Well, I wouldn't have shorted up here because there was no double signal up here. There was just a minor divergence, but it was still against the rotation zone. You don't have, hindsight is always key in this. So that's why you have to trade. It's called the hard right edge. Okay, this is the hard right edge. You don't know what's going to happen. When you even saw this, go back and ask yourself, did you expect Apple When it was still up here, just okay, we had a little divergence top, market was still holding up. Did you expect it to dive down like this? No. A lot of people wouldn't. If you answered, yeah, I expected that, you, maybe 1 out of 10, but not the majority. You trade what is. And that's why you can be wrong about things. It doesn't matter about being wrong. It's more important. I would actually say the best thing of a trader. Could somebody also put in Discord that Tesla's going to be a couple minutes late, the live stream on that? Yeah, I used to play poker. Poker's not my favorite game, but everything's odds. What I would rather see, if I had to recruit traders, you know what I want to see? Here's a little thing. This will be a big tell. Do I want to see somebody who turned in 6 months 10,000 into a million? No, because they probably just got, unless they have some amazing system. But even if they had an amazing system, but to turn 10,000 into a million, you'd just be gambling at that point. You'd just be so leveraged. You ran on a hot streak. And I actually have a story on this. I knew a guy who literally turned 10,000 playing options into 500,000 in 4 months. A year later, he lost that money because he didn't understand what he was doing was just pure leverage, and he hit a streak. And he happened to hit that. He happened to hit like that streak of he hit a hot hands. Whether you're playing blackjack or poker, he hit a streak of hot hands. He kept leveraging into it, and he turned 10,000 into 500,000. A year later, he lost that 500,000. He kept putting money into his account because he thought he was a genius, and he lost another 200,000-300,000 on top of it because he never managed risk. What I would rather see, if I was going to hire a consistent trader, I want consistency and playing the probabilities, playing the risk to reward ratio tied into probabilities with trade expectancy, and consistent behavior. I don't want to see, all right, this one trade I'm trading at 100 shares, and this next trade I'm trading at 1,000 shares, and I ask what changed? Nothing. I just thought this one would be a winner. That's not trading consistently. Trade consistently. Okay? WFC, that's the big thing. Consistency is way better. I'm still bullish on banks longer term. We finally got, this is Wells Fargo, WFC, again from Sterling. I think this is more important. We'll have the company that shall be named later to be there because there are some signals in that too. But this is, look, take a look at the macro. Still bullish on banks. The financials had a big correction, but I'm still bullish on banks, especially with this play. Pulling back to key. Now we start dropping below $50. So this is a great thing. You have a little return. It looks sort of ugly on a daily chart, but look at it on a weekly chart. My stop would be below the rotation zone. Why? Because let's see. Here's a nice base forming. You can even give it a little more room if you want. Look at that nice little trend line right there. Look at all those touches. It's probably right there. But look at all these touches. If you want to give it a little more room there, show a little more room on the stop, I'd just be looking, if you close below here on a daily basis, below 50, I'd be watching for a pullback closer to this trend line and then a potential other entry. But this is what scares people. Oh, blood in the streets with banks. Well, we'll take a look, again, multi-time frame. We might have another longer-term entry set up here. So this is long-term base forming, sort of an ascending triangle pattern. We popped up above it. We've returned to the major base that was forming, and now we're rotating back up. So even if, let's say you get in here, hypothetically, it's a buy. Actually, it's a buy tomorrow on a close above today's high. Let's say that comes back down and closes below 50. Fine. Then it's a stop. Yeah, I got to play the probabilities. There's a very decent percentage. This could have a nice bounce. 53.50. Where's your stop? 50. So you manage your position size with about $3.50 of stop, depending on the close, with a possible return to 58. So do your reward to risk ratio, and the probabilities in that are in the upper 60s, low 70%. And it could be a dead cat bounce in the SPY. We have a short-term capitulation bottom. That's why I've said I need to see how it reacts now off these prices. But the probabilities are in that we should see a 3 to 5 day bounce. If we don't even see a 3-day bounce, then the market has major underlying weakness. So either way, it's going to tell me something. In trading, it's okay to be wrong, and everybody's going to be wrong. It's just a trade didn't work, and it's not necessarily wrong, because that's trying to say I need to be right or wrong versus what I'm trading is a good. It's not even good or bad. It's either a profitable trade or it's an unprofitable trade. But even unprofitable trades, fine. You can't have profitable trades without unprofitable trades. Gambling is a life-changing, and gambling is not a fun job, by the way, because it's when you're doing it as a profession, it's really not fun. You can literally make in counting cards, you can't even make one mistake an hour, and it throws off your odds. So think about that. You can't be, when they show the movies of like people having cocktails and counting cards, you're not having cocktails and everything, and you could be sitting there for 10 straight hours. It's not a glamorous job, but there's the Wells Fargo. Is there a potential buy? Yeah. Return to the rotation zone. Can it be wrong? Yeah, anything can be wrong. Can it be a great trade? Sure. It could be actually a really nice trade. It's still in an uptrend, still holding the weekly rotation zone. Daily, it popped below, but if this rotates up, we'll get a nice double cross pattern and it's holding support. Anything else I missed before I wrap this up? Check out net NQ 4-hour potential H and S. Then this will be it. 4-hour potential H and S. NQ, I'm looking for it. You mean this inverse? Are you talking an inverse one? Hold on, I missed something else. I mean, if we make another shoulder, I could see an inverse one forming, and that would be a nice head. Even a run up here and then a roll over, then a move back up could be an inverse. But we can't do any projections off it yet until it does happen. If I'm not looking at what you're seeing, let me know. And then we have PLTR. PLTR again. This is where people are planner. Oh, Palantir, sorry. It's like planner peanuts to me. Levels on this. Off the most recent rundown, let's see. I'm just seeing where that's decent. I'll tell you first off, on a rally, my key resistance area would be 1460 area right in here. You still have a little gap fill that's not done with the declining rotation zone. That would be my first longer term rally if you're trying to catch a low. And then above that, my major on a bigger rally off of that, if we have more of an intermediate term bottom, my major level would be right here. It's really nice. So if you're trying to play this on a more of a bigger bounce, which I get your stop to break even as fast as possible, but my major level would be about 1950 area. So you have this prior support. You actually have the 50% retracement of this down move. Why am I using that one? Because this was a nice little double top that was triggered and then a relief rally. So this is the next. You have no relief rally yet off of here. That's why I'm using those harmonic levels going down. And you have this very major support shelf. Do I expect it to get there? No. But that would be the level if it kept moving. And this is why it's really nice. Let's hypothetically, again, hypothetical, you had a buy pattern right here. Okay. This is an area if even into a continued strength tomorrow, I'd be unwinding half my position, getting a stop to break even. And if it keeps running, you just keep trailing the stop. And I just keep trailing it higher until, it rolls over. And we're nowhere near a sell signal yet, by the way. So that's how I like to play. If I'm going to play a sort of a dead cat bounce, potential short-term bottom, that's how I like to play it. All right. So with that, thank you. We'll have to do more analysis again tomorrow. I just wanted everybody to hear what Bob had to say sometimes, but rather than coming up with levels. Now I can't figure out. I want to get this. Hold on. There we go. Just real quick, these are, when you see candles like this, things that close. Here's a little, when you see these long-legged dojis close, which is green above the 25% level. Let me reverse those. The close that's green, when you measure the whole candle that's above the 25% level, is a very, very bullish reversal pattern. And this actually closed above the 12.5% level. So that is a bullish for a 3 to 5 day bounce. Okay. The stop being use your 62.5% of this level. So on all the things you're seeing today, the Nasdaq, let me just show you Nasdaq. Here's what you should do on all your charts. Wrong one, sorry. It's been a long day. Come on. Put this, and you see the Nasdaq, here's your 25% bullish close, major reversal candle, 3 to 5 day bounce, invalidated on a move back below the 62.5. So that's where short-term stops are going for stuff for me, okay, based off the indices. And you can put these on every one of them. You have an aggressive short-term bounce trade. Why is it aggressive? Because we're still going against the counter trend, but we're deeply oversold coming out of that. You see the Dow is even above the 12.5% harmonic, and here would be your stop level. So you have a really nice continuation trade, and then you just keep ratcheting up your stop. And then based off tomorrow, if we rally, you wouldn't want it to get below today's opening, this closing area, open area on the Dow, this close open area on the Nasdaq, this close open area on the S&P. So then you can aggressively start raising up your stop. Little tip for everybody. And that tests out very, very well. Does that mean it's guaranteed 100% trade? No, it does not come in at 100% probabilities. There is nothing that comes in at 100% probabilities, period. All right, I'll do that for you, Rich, since you like to pick on me. Kohl's. Wow, what was there? I didn't see any news. Did some news come out on Kohl's? Are they getting, because there was not earnings, are they getting bought out or something? Because that's monster. Does somebody have news on Kohl's? Because I didn't, but I was not specifically looking at a bunch of headlines. Someone's trying to buy that. Okay, that's what that gap looked like. Someone offered $9 billion. See, when I see something like this, I figured it was some kind of buyout. What are they trying to find? What's their share price offer? Because if it's really going to happen, there's not much trading in this unless it's much higher and it's still in doubtful mode. Like if somebody came in and said, I'm offering $80 a share and we're still in possible doubtful mode, there might be a little play to the upside. But if somebody says, I'm offering 64, see, the trade's over. Unless it falls apart. That's the only way it's still a trade. They want 75, that offered 64. So this would only be a short-term breakout trade if they're going to bring something to the table. The risk is if they settle for 64, you don't have any upside because it's a done deal. Here's what you have to gauge. Now, the play would be to 75 in case Kohl's is willing to bend the knee to go to 75, and then you have to look for, if the deal falls apart, you're probably back to $46. So you have to look at your reward to risk. So maybe you got $11 the upside, and you have more than $11 to the downside. So you have to weigh the probabilities of the deal going through. And I'm, without having more insight into this, I couldn't comment on it. But at this point, based off of 64, there's no play. And based off, unless you had major insight information, reward to risk is really challenging. Because it might not be considered a fully done deal yet. That are pricing in risk matrix. So Activison and C, when the deal is supposed to go through at 95 and you see this, it's not fully baked. If it was fully baked, this would be trading 95 and pinned to 95 or very close to 95. This is not. This tells me there's still doubt on the street that this deal is going to happen. So what I like, if you don't think a deal is going to happen, then there are, as Rich just said, would be a great short. There's some shorting opportunities. Now, without doing an in-depth deep dive and sort of coming up with probabilities, I can't tell you what would happen with Kohl's. I can't even tell you with what would happen with Activison. Just off this price level, though, when you start seeing deterioration below the buyout price, think of what's going on. If this was a guaranteed done deal, where would it be trading? Think about it. It'd be 95 because that's where the deal's going to close. And so once the tender offer goes through and it's accepted 95, everybody who owns this is going to essentially get $95 per share. This is telling me that something could still fall apart with the Microsoft deal. Back to Kohl's, you said 64, which makes sense. I mean, we're at 63.61 now, 63.71 after markets. We're also against major resistance, close enough to 64. But if the deal falls apart, it's coming back down. If they up their price, that's the only way. But the moment they up their price, let's say they come back tomorrow and say, no, not 64, we'll do 70. Guess where this is going to gap to instantly? $70. Even intraday, it'll just see boop. You'll just see it run there. So you have to position yourself before that happens. And I'm not going to spend my hours trying to deep dive and second guess whether things like Activison or Kohl's are going to go through. I'm better spent to try to find stuff that, there are people who play these all day long, who really have way more knowledge than me about the probabilities of these deals going through and analyze them left and right. And that's not me. I would rather try to find high probability trades that are setting up rather than taking a shot. But just based off before you guys typed in, when I see a thing like this, and I know Kohl's was looking for a takeover. That's why I also said that. With that, I'm wrapping everything up. Let me get to the company that shall not be named. And we will talk, VIX. We had the nice little reversal. Now I'm wrapping stuff up. By the way, VIX, you can trade. This was also my warning sign. You can actually do your technical analysis on the VIX. It does work. So, and this is with the aggressive targets. If you use, and there's a reason I'm using aggressive targets on this, but if you use conservative, it already hit the second target. I'm watching aggressive targets. So I'm watching for this over the next couple of days to return to at least 27. Easily. And that's also what helped me. All right, we're getting momentum. We're getting all this, and we triggered a double in the VIX. And you see this massive reversal. So you can do technical analysis on the VIX. I keep going. I'm leaving it at that. Yep. I'm glad you guys are here. I'll talk to everyone later. Bye for now.